Welcome to the Yorkshire Shadow MPC, a partnership between Recognition PR, Clive Owen LLP and the York Press. The Bank of England's November interest rate rise was the biggest in 3 decades, taking the rate to 3%. The media is talking up a recession. Is that what our Yorkshire Shadow MPC members see in their own businesses and sectors? And will they vote for a festive interest rate rise? We've got a representative of our Shadow MPC on the line now. We've got 4 members and myself. We're going to talk to them for a few minutes about how they see the economy and then go for an indicative view on whether interest rates should go up or down or stay the same ahead of the Bank of England's real interest rate vote, which is released on Thursday lunchtime. We'll start with Dave Broadbent. Dave is the happiest chappie at Christmas because he runs an insolvency practice. So Dave, tell me, are you busy?
Yes is the honest fact. I wouldn't say we're happy though, because it's never nice to help.
Christmas, I was trying to be nice.
Yes, trying to help people wind the businesses down. But yeah, this will be my 3rd recession that I've worked through. And being completely honest with you, this is probably the worst one that I've come across, just simply because it just doesn't seem to have any. You could normally plan out which sectors would be affected the most, but it just seems to be every single sector at the moment that we're seeing coming through is in some way, shape or form. I was in discussions with a couple of businesses in the last few weeks that have been running for 20 years. I've been in discussions on a regular basis with businesses that have only been running 5 minutes.
Okay. So the sectors aren't common and the age of the businesses aren't common, but are the causes of the insolvency, do they have anything in common?
Yes, I think so. I mean, most recessions are generally driven by people, A, not generally having a lot of cash, but B, I think what's driving this one is the revenue and customs. I've been doing a lot of seminars over the years, and for the last 2 in particular, I've had a slide that said, what are the revenue and customs doing? And the answer's generally been not a great deal. Whereas what we are seeing now, a lot of people are pressing the button, unfortunately, to terminate the businesses, mainly because the revenue and customs are now starting to collect in the £70 billion worth of tax that's floating around at the moment. And I think it all simply boils down to the fact that money is a bit scarce, certainly from their perspective. And the only way in which they can see themselves trying to balance the books is to get some money back from Joe Public or Joe or Jane Public.
Yes, I suppose the government is short of cash. We know that. Massive public deficits, which of course hit all the taxpayers. So there is a moral hazard for not collecting the debt. And I suppose there's a balance to be struck if a business is, what's the phrase, a zombie business? Should it be put out of its misery? So in your view, Dave, are the businesses that are going out of business zombie businesses? Or are they maybe being put out of their life prematurely?
No. I think that's it. I think what happened in 2020, if you look at the numbers back in early 2020 and late 2019, the economy was very, very stagnant. In fact, there was, if memory serves me correctly, I think there was 0 growth and probably minus 0.1% of growth as well. So we were, if you're going to play devil's advocate, we were bordering on a recession back in 2020. And what COVID has effectively done is just slapped the whole economy in a cryogenic freeze for the last couple of years. So what we're seeing now is businesses that are either laden down by borrowings that they had to take out during that period of time to get them over the rocky patch that was 2020, or indeed the fact that it's eventually caught them up where, the ability to push back the payments to your tax, the ability to effectively not have to make any decisions because you weren't really getting pressed by by creditors and in particular revenue and customs. But yeah, I think the government, the other reason why they're driving the big clawback is because they're looking at quite a hefty exposure in relation to all of the guaranteed debts that they provided out there with bounce back loans and the CBIL side of things as well, which are now, unfortunately, businesses are starting to sort of hold their hands up and say, I can't simply pay back that money.
Dave, thank you. Let's move on to Richard Peake, Helmsley Group, investing in property. Richard, you're generally one of our optimistic voices on this panel. What do you see at the moment? I suppose as a property investor, you'll be looking to see that finance is possible and rates have gone up. How is your finance?
To be fair, it's a bit of a mixed bag at the moment. From our client investors' point of view, because we look to invest their funds, so aren't reliant on banks and borrowings at that time. That there is a massive demand out there, obviously, for returns on income. We had client AGM just earlier this week, 125 clients or so. They are, understandably a little bit nervous in terms of where they're going to put the money, but I think they see some opportunities out there in the coming year or couple of years or so. The flip side is, we also do sort of lend money out to small developers who are then sort of building housing schemes, apartment blocks, whatever it might be, and that's where we're probably seeing certainly a slowdown in new inquiries coming through from borrowers. Borrowers are certainly taking a more cautious approach, and those that are on with us at the moment, supporting our borrowers. That's where, when they're getting close to completion of these projects, that their buyers might, and certainly we've had at least 3 cases recently where mortgage providers for buyers have sort of pulled their offers at the last minute, which is sort of just sort of led to a complete sort of a delay on those side of things. So it's a completely mixed bag, if I'm honest with you. You only have to walk around York City Centre, at the weekend, or frankly any time of the week at the moment. And yes, we've got the Christmas market on, but we've had discussions in the office in terms of, well, where is this sort of a crisis of a living, cost of living crisis? People do seem to be out there. Whether they are actually spending a lot of money, I think that's the thing to work out. But
I think, Richard, you're right. I notice in my own sphere, a PR firm with 75 clients turning over £7 billion, the question about recession is, well, it hasn't yet happened. Yeah. But there is a downturn and recession being slightly different scale. From the point of view of interest rates, in September, we had this big peak in long-term interest rates as a result of the instability of that government, that Liz Truss government. The evidence I've heard in marketplaces is that has stabilised and the peaks have just smoothed off a bit. They
have started to come down, undoubtedly. I mean, some of the we continue to lend, but a lot of the other bridging funders and challenger banks either massively hiked their rates or actually sort of stopped lending for a time on that side of things. But I mean, the feedback that I'm getting from the finance brokers I speak to all the time is that, as you say, it is coming down from where it was. I think it is going to sort of stable off at that sort of higher level now for some time, and so buyers and occupiers are going to have to try and deal with that sort of finance rate moving forward and make sure that their businesses or their personal finances can cope with that stuff.
When we get to the interest rate setting question, of course, you've got to balance, haven't you, the need, or your shadow MPC. You don't want to see inflation get out of control, but at the same time, an interest rate that's too seductive for an investor to persuade them to leave their money in the bank rather than have it invested and working in the economy, that is also an important balance, isn't it?
No, absolutely. And I think from that side, we're certainly seeing a demand from investors out there. But as you say, it's got to be for the right sort of yield, invested on the right sort of properties. So it's we think that there will be some opportunities out there, but you have to tread incredibly carefully at the moment. It's a very volatile market.
Okay. On that note, it's probably good to bring in Gary Smith, Tinley Financial Advice. You give a great overview of the general economy, Gary. Let's get your view on how you see the broad macroeconomic picture.
Yeah, quick one. We rebranded since the last meeting, so I currently work for Evelyn Partners. That's the new name.
We'll get that.
So I would say if we were hosting this 6 to 8 weeks ago, I would have been a lot more downbeat. Things have definitely improved since mid-October. It's been a bad year for investing generally. Pretty much every asset class has been down. But we have seen an upturn since mid-October. And the primary reason for that has been an expectation that inflation, especially in the US, has possibly peaked. There was a surprising fall in inflation in November. In America, that resulted in the American market rising quite substantially. And the hope is that the Federal Reserve will only raise interest rates 0.5% on Wednesday rather than 0.75 as they look to take their foot off the accelerator on rate rises and try not to push America into too deep a recession. That's the big concern. On also fixed interest securities, which particularly took a hammering during the short-lived reign of Liz Truss, where the gilt market fell about 30%. We had the unprecedented Bank of England having to intervene in defined benefit pension schemes to stop them collapsing because the values were falling. But we have seen a return for investors looking at that midterm, the 5 to 7 year gilt yield market. So that has stabilized to some extent. And also the pound has strengthened substantially against the dollar from its lows in early October. So we have seen an appetite for increased investment, both in terms of pension contributions and investments generally. Business clients that I'm dealing with, their balance sheets are quite strong. They're sitting with decent amount of cash at the moment. So they are preparing for a recession, but they're not seeing it come through as yet. So I do agree with Richard in terms of spending patterns seem to be continuing. Whether or not this will just hit in the new year, we'll have to see. One positive of the Liz Truss government was annuity rates shot up. They are linked to gilt yields. So what had been the poor relation of the retirement space for the last decade suddenly became very popular. So a healthy individual in their early 60s could get between 7 and 8% as an annuity rate. So that became far more part of the conversation and discussion.
Yeah, it was about 4%, wasn't it, earlier in the year?
Oh, they've pretty much doubled over a 12-month period. They have started to come off again as gilt yields fall and demand for gilts rises. But yeah, you can still get above 6%. And if you're in ill health or if you have any factors that could affect life expectancy, you could be still looking at over 7%. So it's well
Take
worth...
up smoking when you retire. That's the answer there.
Absolutely, yes. Smoking and drinking.
Can I just pull up on a few broader points and get your comments on these factors? I'll just throw a few things at you, Gary. You talked about American interest rates. Both the Fed and the European Central Bank will set their interest rates this week. Inflation has been coming down in America. And then we look at unemployment. Even the Office of Budget Responsibility said in the budget that it would peak at 4.9%, which was 5.1% just 2 years ago that it was. And then you've got the COVID policy in China easing, which might ease supply chain issues. Shipping costs have reduced, and that oil price is priced in dollars, and at time of recording this on Monday lunchtime, it was $1.23. So those are most of those things are counter-inflationary, aren't they?
They are, and certainly in September when it was $1.03 to the pound, it would nearly were at parity. So that was a concern, and the labour market is an interesting one. So the GDP figures for October came out today in the UK, and they were higher than anticipated. So it's very much watch this space. If labour market data comes out as a positive, the Bank of England may have to raise interest more than anticipated when they meet later this week. So again, the Bank of England may put it up anywhere between 0.5 and 0.75% this week. So we could get another large rate rise. The issue with the labour market in America, and the reason why the Federal Reserve have an issue, is for every one unemployed person in America, there are currently 2 jobs available, which is pushing up wages. So you've got, on the balance, Federal Reserve trying to keep things under control, but a poor labour market forcing wages up.
You're about parity here, though. You've got 600,000 economically inactive adults in this country. And you have, slightly more than that in vacancies.
Yeah, I mean, we've had 7 vacancies all year. We've filled about 3. Most of the professional services that I speak with are always looking for staff and have been unable to fill positions this year. So there is definitely an issue with although there might be 600,000 available, there is people aren't applying for jobs and are certainly filling vacancies is a big issue, and that looks like that will continue. Whether that was people retired during COVID, whether it's a fallback from Brexit and the fact that Labour, we've closed our borders to a certain portion of the labour market, we'll have to see. But there are definitely issues filling vacancies at the moment.
Okay, we're going to bring in Philippa now. Now, Philippa Symington is from Clive Owen LLP. Of course, accountants, broad range of accountancy services and advice. Philippa, you just heard Gary. Let's pick up on where he was. Unemployment and vacancies. There was a blue chip chief executive quoted in the Sunday papers this weekend as saying that actually if there is a downturn, the fact that she can't hire at the moment means that she will have right-sized her business by just keeping the number of staff she has. The fact is that the vacancies that are currently in the system will be offset against the downturn rather than having lots of people made unemployed. What's your view from the marketplace when you're talking to clients of Clive Owen LLP?
I think from a client perspective, it's like most things, it's that balance. There are definitely people going exactly that route and saying they need people, they need this, the place is filled. And then you've got the people on the flip side saying, well, if we can't grow the business, if we can't continue at the levels that we are, which that's obviously what the expectation is with a recession, is that they will not need the people, or they will not need the heads to fill those spaces. We've also seen some really, I suppose, out of the box thinking where people are suddenly recruiting from overseas, or they're recruiting temporary people instead of having full-time people. Or, I mean, we've also seen the other flip side where people are going 4 days a week instead of having 5 days a week. So I think people are really adapting their thought processes and their businesses to, it's challenges that we haven't had in the past.
That's right.
And people have had to just think differently on how to resolve them.
What evidence are you seeing in you're a large group of clients, much more than mine. What evidence, if any, are you seeing on price rises? I've seen a lot of price rises on the things that my clients sell, but the price rises appear to have abated a bit now.
I think what we were going through just recently is a big, all the raw material prices were increasing, and that was based on things like foreign exchange rates that are changing, but also, I think there's also, you've got companies that jump on the bandwagon and increase prices because they can. It's fuel prices that have been increasing. So all of that has definitely impacted the prices, but I think some of that it's settling. But we've also had a lot of companies that have had to, buy to keep their supply agreements in place. So, for instance, I've got a couple of clients in the warehousing space, and they've had an absolute bumper year because people are buying goods that they're not necessarily selling as quickly as they'd hoped, or just to maintain those supply agreements so that when we do get into a position of a bit more normality, they've got the goods to sell. Okay. So warehousing space is in short supply at the moment.
And are there any other trends that you think we should just be aware of before we go to our vote on the rate of interest?
I think hospitality's had a great year this year, but going into 2023 are finding it a bit more difficult. I think it's so dependent on people's spending power and what they can do at that moment in time, and whether or not they can get out the country or whether they've got to stay here because of lockdowns and things like that. So 2022 was a great year for them. 2023 is definitely showing different signs. I think it also shows a sign of people being a bit more careful on their spending, which I know kind of contradicts some of the other things that have been said, but I think it's the individuals are being more careful.
Okay, let's put our team on the gallery then and get everyone ready for a vote. So the question is, and I'm allowed to vote in this as well because I run a business, and it's only indicative of our panel, our larger panel. The question first is, does anybody feel that interest rates should come down when the Bank of England meets this week? No. Does anyone think that interest rates should remain the same? No, surprising. The North East Shadow MPC might be a bit more split on that. Does anybody think that interest rates should rise? Oh, and it's a unanimous on this group. Now, I'm going to just quickly go around the table and ask how much by. My view is that they shouldn't rise by more than 0.5, and then I think the monetary medicine should be allowed to do its work, and let's see what inflation does. And I caveat it by the fact that we're saying this before we know what the inflation rate is. It's announced on Wednesday. The real Bank of England will know. What about your rate rise? Philippa, what rate would you like to see it go up by?
Oh, I don't know if I'd like to see it go up, but I think it's going to go up as we've got these pressures in the economy and the inflation that's continuing to rise. I would say about 0.5%.
You're a 0.5er. Gary, where are you? Inflation's still there. Should it be?
I think it'll be 0.5, although, as I said, if the labour market data
But this isn't a prediction, is it, Gary? What do you think it should be, rather than a prediction? What's your opinion?
Yeah, 0.5.
You're a 0.5er, and your reason is the labour market itself?
Yeah, and we know it's got to go up. We are lagging behind the rest of the world with interest rate rises, but the 0.5 is required.
We don't
minimum.
want to see the pound struggling again because we're not at the right interest rate, do we? Dave Broadbent, where do you sit?
It's a good question you were saying earlier about what will we want and what do we think is going to happen. I think I'm with everybody, and we think it's going to increase by 0.5%. Personally, I would hope that it didn't increase at all, but I just can't see that they just can't afford to do that.
But this is a shadow MPC. Are you saying you want to pull your vote back and you would not vote for a rise, or would you vote for a rise?
I'm quite happy to. I'm happy to go with a not for a rise then, just simply because I think there's enough pressures on Joe Public's purse at the moment, and I think popping an extra 0.5%. There's a lot of people out there with interest-only mortgages that I suspect are going to feel a lot of a pinch. That 0.5 is going to be a big jump for a lot of people on top of what it's been before.
Right, that's interesting. And by the way, interest mortgages, that 28% of people have a mortgage. Richard Peake, where are you on the rate?
Well, to be fair, Dave stole most of my thunder. That's right. About a quarter of a point, I would think.
You're a 0.25 man. All right, so it's a little bit of a split, it's not unanimous. It's a majority going for a rise, and the majority of that majority is for 0.5. Thank you very much, ladies and gentlemen. That's our Yorkshire Shadow MPC December 2022.